Okay, this is to help explain through these test 3 review problems. So the first one is back to if we are making a purchase of inventory and we are not buying from a U.S. supplier, but from an international company that is, has a different foreign currency, and we need to translate those currencies into our accounts receivable. Okay, so the problem says that we are purchasing from a supplier in Switzerland, and the invoice specifies that the payment will be made in Swiss francs on February 20th in the amount of 4,000 Swiss francs. So on November 20th, when we make the purchase, it tells us the exchange rate is $1.18 for one. So it takes $1.18 of US dollars to equal 1 Swiss franc. So then if we take the 4,000 Swiss franc that we owe times the $1.18 conversion rate, that means we're going to value the inventory at 4,720 US dollars and set up a liability for that. Then GAAP requires us at the end of the year to make sure our liabilities are fairly stated. So then we look at that accounts receivable and say, okay, is it still really 4,720 US dollars? No, the exchange rate has changed. So the US dollar has gone down. So now it is $1.05 to get 1 Swiss franc. So then now our liability is actually less because, again, it takes less US dollars to buy the Swiss franc. So then now we say, okay, if we owe 4,000 Swiss francs and it takes $1.05 to get 1, our new liability is 4,200. So then we're going to reduce our accounts payable by the difference. The 4,720 minus that 4,200 is where the 520 comes in. And then again, we're reducing it. So we're going to debit it. So then that means we have a credit that we need to book. So the credit tells us it's a gain. And again, if you just look at the dollars amounts, we're going to settle the liability for less. So then we have a foreign currency translation gain of $520. Then on February 20th, when we actually settle it, the US dollar goes back up. So it's $1.12 to buy 1 Swiss franc. So then we take the 4,000 Swiss franc that we owe by the $1.12, and to settle the liability, it's 4,480. We had 4,200 in our accounts payable at the end of the year. So then now we have to come up with that additional $280. It's a debit. So then it's going to be a loss. So then this foreign currency translation loss is going to be offset, or it's going to offset that gain. Okay, then we get into our estate journal entries. So when you do the estates, basically you're just going to go bullet point by bullet point or item by item and then do the journal entry. So this first one here, we're setting up the initial estate when the person dies. So we have cash. Now it's called cash principal when it goes into the estate. Then we have our stock valued at what the current market value is on the date of death. Then we have the bonds that are also at the current value. And then there's an interest receivable on those bonds. It tells us that as of February, there's a $4,000 interest receivable accrued. So we've got to set that up. And then on those Bayside stocks, it tells us that there was dividends declared, but they'll be paid in March. So then we know we have a $9,000 receivable. We sum all those up, and that equals our estate principal. Then you go through each transaction. So number 2, you've got they actually receive that Bayside dividend. It gets paid to them. So again, cash comes in, so it goes to cash principal, and we reduce the dividend receivable. Then the next transaction, they discover some land that they did not know existed. So this is their aunt or whatever, and they didn't know she had this land. So they set it up as a new asset to her estate called land, and then it credits to assets subsequently discovered because it isn't a part of the original estate. It was added later. Then the 4th bullet point has funeral expenses, legal costs, her final income tax that needs to be paid, any credit cards and things that came in, or utility bills. So everything is kind of totaled up, all of her final expenses, and we debit those out, and then we credit the cash principal. Then there is a Bayside, oh, I'm sorry, in that one, this $500, this tells us that there were legal fees, that $500 of those related to income on the estate. So if it relates to income which happens on the estate after the date of death, it's an expense against income, and then it doesn't come out of the cash principal, it comes out of the cash income. So that we'll kind of separate the cash as it's coming into the estate and call that cash income. Then number 5, they sell the base stocks and the Bayside stock. So they receive the cash of $250,000. Then we compare it though to what they had on the book. So again, it was the $235,000 that we valued it at. So we take that out, and then the difference is a gain on the sale of the stock. Then the next transaction, they sell those bonds. So again, we look back over here and say, okay, our bonds are valued at $510,000. So then we're going to take those off of the books. They receive, they say they sell it for 107 plus accrued interest. So you'd have to take the principal or the par value of those bonds, which is up in the given information up at the top. It's 480,000 is the par value times the 107 because they're sold at a premium. So that's the cash that's received. Then we're going to get the dividends the interest that would have been accrued up to that point. So that is the $4,000, and then we take that off of our interest receivable. And then the difference is going to be to a gain. So we sold them for more than what we had them on our books for. Then we have the legacy is distributed. So we've got legacies distributed for $310,000. Then we take it out of the cash and the land because it tells us that part of the land is getting paid out. And then the income. The income, again, is distributed separately because it comes out of that cash income, which is, again, separate than the cash principal. So that's the only thing I think that gets confusing is that you got to keep any money that comes in after the person dies separately as cash income, and then have estate income or estate expenses. And then if it gets dispersed, obviously it's going to get paid out of that. All right, then the next one is your big problem. The first step that you have to do is you have to translate the subsidiaries' financial statements. So the key to those is what rates you use. So the balance sheet, we use the end of the year exchange rate, except for when it comes to our common stock and our paid-in capital, that we use the historic rate. The retained earnings is going to roll from the statement of retained earnings, which I don't have that pictured over. I don't have that picture in here. But so again, if we were to do if you do your income statement, you convert your income statement at the weighted average rate, and then you do your statement of retained earnings. The thing you want to remember with your statement of retained earnings is the beginning value is always going to be given to you. Then your income's going to roll in. You subtract your dividends out at the dividend exchange rate, and then that ending balance rolls down into our balance sheet. And then because everything is kind of coming in at a different translation rate, we're going to need a line item that makes the balance sheet balance, and that is this cumulative translation adjustment, and that's our plug number. Then once we have the plug number, we can compare that to where it started, our beginning of the year balance, which the problem gives to us. And then that will give us when we subtract those, we'll have our current year amount. So our beginning of the year balance goes down into our E entry, and then our current year amount goes into our C entry. Other than that, though, the E entry and the C entry are the same as what they always have been. We just now add the beginning of the year cumulative adjustment and the current year addition to the cumulative adjustment. Now our D entry and our A entry deal with the acquisition accounting premium. Land is a little bit easier because it does not depreciate. So what we have in our A entry is our beginning of the year balance. So our 300,000, what are these? Brazilian reals multiplied by the end of the year rate, which gives us a value of 126,000. But then we come over here and we compare it to what's our end of the year value. So our end of the year rate is 57 cents. So we take our 300,000 Brazilian reals and multiply that by 57 cents and we get 171,000. So we have to account for this change in value in the land, and all it relates to is the change in the exchange rates. So then our translation gain is going to be what we need to book to bring that land up to the end of the year value. So then those will be the entries that you will have to complete then on your test. Then when we get into our chapter 13, you're going to have two problems. So the first one deals with the bonus method. So we had the goodwill method and the bonus method. So what it's saying is when these partners come together, the one partner is contributing net assets of $100,000. The other one is contributing $150,000 in cash, but they are agreeing that they are 50-50 partners. But obviously one's bringing $100,000 and the other one's bringing $150,000. So the asset-wise, they're not 50-50, but we recognize that there must be a reason that they're willing to go 50-50, so that the one partner is maybe bringing customers or something else. So then the question is going to be, how do we record it? So we record our cash, the $150,000 that partner B is bringing in, plus the $40,000 that partner A has on their balance sheet, for a total of $190,000. Then we bring in the inventory and the receivables, and we offset the accounts payable and the liabilities based on what that partner is bringing in. So just taking it right off of their balance sheet and recording those in. Then we come down and say, okay, well, we know between the two partners, there's $250,000 of equity. They're choosing not to record any goodwill, so they're just going to split that $250,000. So each partner gets $125,000. So in a sense, partner B is giving partner A a little bit of a bonus. He's getting $125,000 worth of equity for his $100,000 worth of net assets. Okay, then the last problem is going to be kind of setting up the entire partnership from start to finish. So with this one, again, we have three partners. Partner A and partner B are in the partnership. They each have a capital account of $500,000. So that's their current balances. Partner C is admitted into the partnership June 1st with $300,000. So her $300,000 comes in. Then they tell us in the problem that during the year, the partners withdrew $25,000 for A and B and $12,500 for C. So we need to subtract those drawings out. They are withdrawing those from their capital accounts. It tells us that partner C is going to get a salary of $80,000. So we give that to her. And then we come down and we calculate our interest. It tells us that there's interest of 5% on their capital balances. So you take 5% times the 500,000, and that's where this 25,000 comes in. 5% of the 500,000, that's where that 25,000 comes in. Now, since partner C was not there for the whole year, she only gets interest for the time that she was there. So she contributed 300,000 on June 1st. So she'll get 5% for 7 months, so 7 out of 12. So that is the 8,750. Now, when we come down to the profit split, you could have a separate little column off to the side, which is kind of what I've tried to do over here. So we started with 700,000, which was the $1,250,000 of revenue, less the 550,000 of expenses, leaves us at 700,000 profit. We have to first subtract off the 80,000 paid to partner C, so that leaves 620,000. Then we have to subtract out the $58,750 of interest. That leaves $561,250 to split. And then we multiply that by their partnership agreement splits. So partner A gets 35%, partner B gets 35%, and partner C gets 30%. So if you take the 561,250 times 35%, that gives us 196,437. Same thing to partner B, and then that remainder goes to partner C.